Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today, as always, Michael Becker.
Hey, Paul.
So we're going to look back on 2017. We're getting towards the end of the year, Michael, and 2017 has been a good year in the apartment business, whether you're an owner like Michael or a loner like Paul Peebles. Yes, I have no friends, but we do lend $700+ million a year in multifamily. So we kind of have a unique perspective of what multifamily financing looks like, probably better than a lot of other lenders out there. So I thought we'd just kind of do an overview of what we saw for 2017. And Mike, what's kind of been your perspective on the buying side of 2017?
Yeah, really. So I kind of have, I think, perspective into two different aspects, really kind of the acquisition / disposition. So what's going on in the markets essentially, as well as kind of operationally, just by running, a relatively large portfolio. So operationally, it's pretty slow and steady. There was not a whole lot of gyrations. The rents kind of steadily climbed up in the Dallas market where I'm based, and I think that's the case in most places across the country, that the market rates have still increased, generally speaking, just kind of slowed the pace of the growth. We had Greg Willett on, obviously. He mentioned that a few months ago when he was talking about that. Still pretty solid performance. The urban core market's a little bit softer, and the suburban market seemed to be performing pretty well. On the transactional side, on the buying and the selling side, it certainly was a relatively tough year out in the marketplace. There's a lot of competition. At the beginning, end of 2016, the beginning of 2017, there was a pretty sharp rise in 10-year Treasury, which caused the rates to go up. Throughout the year, those kind of settled down and kind of normalized a little bit more. So it's a pretty stable year from the 10-year Treasury. But what happened at the beginning of the year, when the rates rose, the cap rates really didn't move a whole lot. So we had a lot of deals in the first part of the year that were a little tighter from a cap rate to yield perspective. So the yield just got a little bit tighter, and the marketplace pretty much just absorbed it. There's a lot of money out there chasing deals. So all these marketed deals were pretty well competitive. What my firm, SPI Advisor, decided to do is we kind of zigged when other people zagged. We try to really focus a little bit more on loan assumptions. So we bought 5 properties this year, and 4 of the 5 were on loan assumption. And the only one that we did all cash was at the beginning of the year. We kind of locked it in at the end of 2016. So that's really what we focused on. It's been a healthy market, a lot of competition, a lot of active money chasing inventory on stabilized apartment complexes. There's not a lot of distress in the marketplace. So there's some value add still left in the marketplace, but it's really kind of the low-hanging fruit, and a lot of that stuff is kind of gone. So a lot of the value add is like the 2.0 renovations. A lot of the ownership groups have gone in and done a certain percentage of the unit upgrades and the new value adds coming in, and either taking that same upgrade level to the next level or just continuing what the previous owner had set out as like a game plan. What really was going on in the debt markets, Paul? Anything you changed or noticed that changed in 2017 versus kind of the previous years?
No, pretty much the same as 2016 going to 2017, that there was an interest rate spike at the end of 2016 with the announcement of Trump being the president of the United States. I don't think anybody was looking at that as being a way it was going to happen. And so interest rates rose, and it just as a learning piece for everybody to understand. Mike, you went through a little bit of a haircut on that deal. Tell me a little bit more about what happened to you and how people in the future, if interest rates rise dramatically, what that can do for proceeds of transactions.
Yeah, so we're in escrow to buy 2 deals. It happened on 2 deals of ours. One closed at the end of 2016 and one closed in January of this year. And basically what happened was we agreed to a price and didn't have a financing contingency in the deal, which is pretty much the way of the world today. And for whatever reason, the seller needed a longer escrow. So while we're in escrow, the 10-year Treasury kept rising, which meant our interest rate kept going up. And you have to have a 125 debt coverage ratio, as we talked about on previous podcast. And so the NOI was pretty much the same, but my debt service went up. So what happened, the banker's playbook is to cut loan proceeds. So one deal, I think we got cut about $1.8 million, and the other about $1.5 million or $1.6 million in loan proceeds. So it was a pretty tough end of the year, no question. So you had to kind of figure it out. And essentially what we ended up doing is just raising a little bit more capital and having a little bit more equity in the deal. So that's essentially what happens in a rising rate environment when you get what we call debt service constrained. And that's certainly what happened to us at the beginning of this year with the transaction that we closed.
So I would tell you on the financing side for 2017, everything was kind of straightforward. Nothing was pulling back on the lenders. If you're going to do an acquisition and if you're going to use bank financing, typically it was going to be maybe 75% leverage, 25-year amortization, rates in the high 4s, low 5s, some interest only on the deal. If you could qualify for your Fannie Mae Country Club card, you had some previous multifamily experience, you were 30-year amortizations with a couple years of interest only, on permanent debt from 10 to 12 years, fixed rates. So that, with the higher leverage at 80%, that was probably the Cadillac of loans. If you had something kind of funny or funky about the transaction, it couldn't qualify for bank or it couldn't qualify for Fannie Mae, but you still needed maybe a non-recourse deal, you could probably do a CMBS. And CMBS was probably 75% leverage, and CMBS stands for commercial mortgage-backed security. So if you were maybe looking at a property that just wouldn't fit the box, whether it was a foreign investor trying to buy a property in the United States and then maybe never had owned anything in the United States, a CMBS would be one to do it, or there was something funky about the transaction. That's just another way of doing it. Debt funds were out there. They were pretty active on the bridge lending. So if you had a transaction that needed a bridge loan, that something was materially kind of funky about the deal, that whether it was deferred maintenance or management was an issue, you needed to bridge it to be able to do a permanent loan down the road, debt funds were available out there too. So my 2 cents, Mike, for 2017, all the gates were open. A little bit of restraint on probably the construction piece. If you wanted to
maybe talk through that a little bit, because when my previous life, I did some construction lending pre-recession, and back 10, 12 years ago would be 80% pretty much across the board on loan to cost or loan to value, lesser of. What's been like the recent transactions that get done? What kind of terms are those getting done at?
So we do a large amount of ground up construction. So if you wanted to build an apartment building or build a self-storage or build something, we do a lot of ground up construction of different property types. But in the multifamily space, Mike, when you were doing loans, what was your leverage at that period of time?
Yeah, we were, like I said, pre-recession was 75 to 80. 80 was very common.
Not anymore. So it's gone down from 75 to 80% down to 70%, but really it's at 65% leverage. I think on the multifamily side, be prepared to put down 30 or 35% into a deal. Again, a construction loan could be anywhere from maybe a 36-month loan, interest only during that period of time, maybe rates in the mid-4s or so, usually tied to a LIBOR index, full recourse typically in the deal. And if you're trying to get some higher leverage in the deal, you have to do something called mezzanine piece. It's really not a debt because the lender doesn't want to see a debt to the deal, but it goes to the partnership typically. And that could be 11 or 12%. So you're kind of borrowing money for the partnership to get a little bit higher leverage. And we can help on some of that stuff too. But the biggest thing is that what we're seeing is HVCRE, HV, high volatility commercial real estate. It's kind of thing was passed a couple of years ago, but it really affects people that maybe bought land and we're going to donate the land into the transaction. If they bought it for $1 million, and now a couple of years when they bought it was $1 million, now they think it's worth about $2 or $3 million. We want to make sure that we have at least 15% of person's cash liquidity into the deal. And we typically are not going to use the $2 or $3 million value appreciation. We're going to use the $1 million into the deal, whatever you bought that property for. Because the downside is for the bank is that if they don't use that, they have to put more capital aside. So they really are pushing the borrower to put more liquidity, more cash into the deal, and not use appreciation into the deal. So that's been probably a big thing for people that are building new apartment buildings. So just know that in the back of your head that you just can't take the land appreciation if you bought it 5 or 10 years ago. So
yeah, so that's one thing I think that you and I have been around the block a time or two, noticing that this time's a little different than last time from the banker's perspective, that the banks 10, 12 years ago were doing some silly stuff, doing really high leverage, and this time it's been really restrained within the banking, the way they're structuring these loans. I've been having lower leverage, making sure that you have actual, in the way you underwrite the Fannie Mae loans, make sure they underwrite your revenue based off of actual collections. They're not really using pro forma revenue on the Fannie Mae loans, and they're adjusting the expenses up. So it seems like whatever the next down cycle is going to not start from the banking or the lending like it did last time. Last time, really was a bank-driven event, where now it's really going to, not be a bank-driven debt. I'm not sure what it's going to be, but it certainly seems like the banks are pretty much in check.
So what's in store for 2018? That's just right around the corner here. It's a week or two away from 2018. So my perspective on the banking lending side is that I think it's really more of a wash, rinse, and repeat, similar to what it was in 2017. I don't think we have anything that's on the horizon that on the capital markets lending side that's going to cause us to have a stumble or a fall. There's always possibilities of black swan events, these once in a lifetime type of deals that if it's flooding in Houston, that doesn't seem like it's a once in a lifetime. That comes every couple of years. But there may be events out there that can trigger capital markets to collapse. But right now, I don't see anything that's on the horizon. A lot of lenders are not pulling back. They're just being, they analyze it, make sure it does make sense, and that everybody can win in the deal. How about on the real estate side, Mike? What do you see?
It seems to be much of the same going in 2018 from 2017. Really, the biggest variable as we record this is just about to be passed is the Tax Reform Act. They're going to do some tax reform and lower the corporate tax rates and do some other modifications. And so it certainly isn't final as we record this. But what I read, it seems like the way the Congress has written the Tax Reform Act is like exactly perfect for guys like myself, for real estate investors, commercial real estate investors. They're saving all the tax breaks that are currently in place with the depreciation, as well as they're going to lower the pass-through rate for partnerships and S-corps as well. So it seems like it's going to be very bullish for a real estate investor from a taxation standpoint. So if I was to speculate, I would imagine that would make all these deals look even that much more attractive to potential buyers, and it might even have the impact of pushing pricing a little bit more aggressively because your after-tax returns are even going to be greater, and hopefully it might even loosen up some of this inventory that's been locked up forever and ever just because people don't want to pay these high tax amounts, and having a lower tax amount that's due if you sell it potentially could even push us forward a little bit more and loosen up some more inventory. But generally speaking, I'm of the same sentiment as you. I think it's kind of rinse and repeat. Obviously, we're a little late in the cycle. Cycle's been going on a while, so I don't quite sure when it's going to end. So I would preach that people be cautious about what they buy and their locations. I've mentioned this multiple times on the podcast. My fear is that I'm seeing a lot of stuff that are in some questionable locations that used to trade at $8,000 or $10,000 a unit here locally, trading in the 60s and 70s a unit. And it's because, the rents are up and the occupancy's full. But, whenever the market cycles the next time, there's some structural fundamental issues with those locations or that real estate that'll pop its ugly head back up whenever the next cycle, down cycle comes. So just be careful about the type of product you buy and the location. I think it is not something to stretch on location. That would be what I would pound the table on for 2018.
Other things that we do, not just multifamily, but that's the majority of our business, but also do office and retail and things like that. Things that I would be a little bit hesitant on is maybe things like tertiary malls. A lot of has been written about this, but very few people are attempting to revitalize these malls. So think of these malls in secondary and tertiary markets, 25, 30,000 population or less, or even smaller. It takes a lot of cooperation with municipalities to try to turn these things around. And I think that's going to be a problem in the future. Also, things like big box retailers. That's something we've talked about in the past. What type of an impact has Amazon done to all these things? So that's not a surprise either. And we're seeing a lot of very little capital flowing into that segment. And it's more of a speculator sport than anything. And so, maybe markets will tend to fail on those deals. And urban multifamily. I mean, you're a suburban guy. Tell us a little bit about why urban multifamily is overbuilt.
I mean, really, you just listened to Greg Willis' podcast of a couple of months ago. I mean, he talks about it. I mean, the supply that's being delivered is either in the top flight suburbs or an urban core, with a lot of it being an urban core. So it's the way the cost structure of these deals work. With land costs going up, with labor and materials going up, they have to pro forma these really high rents. So to do that, they're building, luxury apartments. Essentially, they're not building workforce housing apartments. And so there's a lot of the top of the market supply being delivered in a concentrated area in a short period of time. Supply and demand appears to be getting a little bit out of whack in the urban core luxury apartment complexes. So that's why, my firm and what most of the clients that we loan money to at Old Capital focus kind of more on the suburban multifamily, certainly on the workforce multifamily. Those two parts seem to be a little bit more insulated from a lot of the supply.
What do you think about the inflow of capital? I mean, probably 95% of all the multifamily middle market stuff is $50 million and below of apartment buildings. I mean, that's a big segment. Who's buying that type of stuff? Again, $50 million. Is it individuals and not institutions?
Yeah, most of kind of the middle market real estate be, kind of the mid 20s to mid, say, $50 million range. And most of that still is private capital. You do have a few institutional players, but they're kind of the lower end. Blackstone and these big Wall Street firms just can't deploy enough capital buying $50 million in chunks. So really a lot of the REITs and the Wall Street capital is really focused on the $100+ million portfolio type product, and the middle market is still pretty much private capital, either syndicators or maybe like a small fund that kind of aggregates some capital and invests with JV with sponsors.
And how are you saying the capital come in? Is it still, whether you're trying to raise on a $3 million acquisition or a $10 million acquisition, still like individuals, mom and pop, small family offices that are putting money on that?
Certainly in like the under 10 or 15 million. I mean, virtually all these deals are either single owners where they just have their own capital. Maybe it's a 1031 buyer from California or someplace else that has a big gain. They buy a property here, or, the majority of these are just syndicated capital. So just mom and pop investors pull their capital together and buy a deal.
So you're still pretty thumbs up on raising money out there?
For everyone that's relatively new in this business, I mean, this has been the golden age, no question. So right now, the ability to attract capital and raise capital is abundant out there right now. So trying to not take this for granted. This is a great market to go out and raise capital. There's still attractive debt terms out there, and the economy still seems to be doing pretty well. So just making sure you don't get out above your skis. You're buying in the good location. I still believe it's a pretty good time to operate, and we're putting our money where our mouth is, and we're still doing deals.
So I think looking for the future on the podcast, coming up in January, we're going to have a couple different people that you may have not heard of. One is you may have heard of. We've talked with her before, but it really is, she's an absolute queen of multifamily. Her name is Kim Radiker. We're going to have her on in January. We just closed a $40-some million acquisition, but she started with 77 doors, Michael. You made her first loan?
Made her first loan when I worked at Wells Fargo. I think it was 77 doors and a little bit over $1 million. I can't remember exactly what it was, but something like that.
And she's bought a couple thousand units and value added, and she is a wealth of knowledge. You really want to listen to that podcast. That's going to be coming up in January. She is, I call her the queen of multifamily, especially because all the guys buy multifamily, and so she's kind of an anomaly. And we've been trying to push to have more women come in and buy apartments. So make sure if your wife, your girlfriend listen to this podcast, because it can be done. So let's get more women into the business. Charles Lemaire is going to come up in the podcast. He's an interesting guy because he's a passive investor. We kind of talk a lot about the active investors, the managing members, the guys that are putting these deals together. Well, for every one managing member, you got to have 10, 12, 15, 100 limited partners. And so Charles is a limited partner in a number of transactions. We kind of want to find out, why do you get into this deal and not that deal? What makes that deal bad versus this deal being good? Have you got into bad deals? What was a bad deal? What do you look for in a managing member? I think he's going to have a wealth of information. Anything more than that?
No, yeah, that's a different perspective. The other side of the coin, right? You need to understand what you're looking at if you're going to put your capital at risk. So I think that'd be a good interview.
And then we'll have one of our local attorneys, Brian Hammer, is going to come into the podcast, and he's going to talk a little bit about what should be in sales contracts or what should not be in sales contracts. What are the things that are going to hook you in a sales contract. So you want to kind of listen to him, what his perspective is. Again, he's a Texas attorney, but just general rules of thumb of what's important, what's not important in these sales contracts. Things that you may have $300,000-$400,000 in non-refundable earnest money. Make sure you understand a little bit more about what those contracts are and what they are going to hold you out to be.
Yeah. So what do we have coming up? We're going to engage the Old Capital Speaker Series again.
That comes up in February. We'll kick it off with that. March, we'll have Dr. Dotzer in. So, we have plenty of learning, teaching exercise for people out there. 2017 was a good year. We're anticipating 2018 to be another good year. And I think the theme for 2018 on the Old Capital side is get in the game. Get in the game. It's not too late. It is time to do some analysis, get yourself educated with a good mentoring group that has the capital that stands behind it, that understands a little bit about what you want to do, that can kind of teach you, because you may have to pay a cost to get into a mentoring program, but that cost it's a cost of doing business, for one, educating yourself, but it will save you a lot of money and time. That if you don't have the experience, make sure you get into a mentoring group that actually can help you. So we're big believers in getting into the game. So get into the game for 2018. That's our theme.
And we're going to do another Old Capital Conference. We're going to do the second annual in October?
October. And so we had 475 people October 2017. We're probably going to have 500, 600, 700 in this conference that's coming up. People from all over the United States coming in to visit with us and kind of listen a little bit about what's going on. So just a all-day event, and we'll announce that a little closer to the event. One of the things that we do have, and I think that if anybody wants to listen and watch me, I'm going to go out to Northern California on Tuesday, January the 9th. In the show notes on the podcast, we'll tell you how to listen to me, watch me, and I'll talk a little bit about Fannie Mae and talk a little bit about Freddie Mac and how to structure these transactions. I'm bringing out one of our underwriters, and we're going to kind of go through some case studies and kind of have you understand a little bit about what's going on. So January 9th up in the Los Gatos area. So I'll be speaking at that event, and we'll look in the show notes and then how you can click, and hopefully you can join us on that and learn a little bit more about what's going on in multifamily financing. So we really would want to wish you a great holiday season. We're going to be off next week enjoying our family. Michael and I will, but we do very much appreciate all the great comments that you've made. And if you do want to learn anything more about multifamily, don't forget to get into the Old Capital White Paper. That's a 15-page white paper that Michael and I wrote, just kind of give you the basics of multifamily financing. Go to the Old Capital Podcast website, go to the right-hand side, double-click that, and download that and understand it. And Michael also has thrown in his due diligence report, kind of helps you understand a little bit about what he looks for when he is doing his analysis, trying to buy a property. And then also, too, if you have a chance, and that's probably our big thing for 2018, is give us a 5-star report. If you think the information that we give you is valuable, we would appreciate that, a 5-star report on iTunes or Stitcher, wherever you
can refer a friend. You're right. That's a big push. We're trying to grow the listener base. So the more you guys get the word out, post it on social media, we definitely appreciate it.
We definitely appreciate it. Well, have a great holiday season with your friends and your family and your work colleagues and your partners in all these transactions. Again, I'm Paul Peebles. That was Michael Becker. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.